learning about price patterns. Let's jump into the next price pattern, which is the V-top pattern. The V-top pattern occurs when the price sharply moves up in one direction, that is upwards, and then sharply falls down in the downward direction. And then it breaks the neckline. You sell here, or if you are someone who is planning to short, then you can enter the trade here. You can expect the price to go as low as the points between the neckline and the top of the V bottom pattern, and your stop loss can be again 4 to 5%. We have an opposite of V top pattern, that is the V bottom pattern. In the V bottom pattern, the price sharply moves in the downward direction and then moves up sharply in the upward direction. Once it crosses the neckline, you can enter the trade or you can buy the trade. You can expect the price to move as many points as the lowest point of the V bottom pattern and the neckline. Your stop loss can be 4 to 5%. During COVID times, you can see a lot of charts that have the V bottom pattern. We will look into an example. This is a chart of Tata Consumer Product, and you can see here, and this is a monthly chart, you can see here, this is a very clear V bottom pattern. So you can see the price going down from 300s to 175, and then it sharply started moving up, and it came back to the 300 levels and it broke the price, and there was a slight rejection initially, but then, as I said, the price patterns are 90 to 95% reliable. You can see the price going up, and it went up till 540s. So this was V top and V bottom patterns. I will see you in the next video with another price pattern. Till then, take care. Cheers.